Hi everybody, this is Gary Dean with Sentiment Timing, and this is our special free weekly video for Sunday, July 8th, 2018. I hope you guys are having a fantastic weekend, and I decided just to get a quick little report out to one, show you how things have been lining up, how they've lined up in the past, and really what's going to be taking place moving forward. So using our predictive analytic model, it's been really making our trades pretty stress-free. Now, there's been some moments of stress, I'm not going to lie to you, but when you know what to expect, even when you get into a trade and it actually goes the other way, you don't get emotional about it because you know that you have the time on your hands, which is expected turn date. You have sentiment that's backing it, and then all you have to do is just look for where the price will reverse. And when that happens, you're able to really remove your emotions. You put your stop in place, and you don't have to sit in front of your computer and watch every tick. There's just better things in life to be doing than that. And when you watch every tick, it allows your your emotions to take control. And when you make an emotional trade, you're going to be wrong 99.9% of the time. And that's really where the sentiment part of our predictive analytics model comes into play, because the majority is always going to be wrong at some point, whether it be the market pressing higher and everybody's jumping on the bullish side because they don't think it's going to go down, or when the markets can't get out of their way and they keep getting sold off. You see everybody get bearish on the market, and usually when you get those extreme sentiment readings, whether it be on a top or a bottom, you can pretty much assure that there's going to be a reversal that's going to be pending. And it's not something that it's not a buy or sell signal, but it's a good way to use things as an indicator. And I've mentioned plenty of times. I mean, Woody's one of the pioneers in investor sentiment. He's one of the few people in the world that actually track investor sentiment on a daily basis and charts it. So it gives us an unfair advantage over, I don't care what system's out there, whether it be Elliott Wave, cycles. When you're just using price alone, it's going to mess you up, because if you're sitting there and you're looking for some type of, if you're thinking about this on an Elliott Wave perspective, a wave 5 up where it's going to reverse, but you don't know when the time part, when it's supposed to reverse, what's going to happen is it's going to continue up or down, and these wave counters have to then restructure their wave count to make it fit what's going on. When you're using just cycles or just time, and you don't have sentiment that's backing that up, what happens is you get this inverted cycle. Or I don't really follow them like that much, but they have all these different names, but they're names for why they're wrong. And when you're able to combine everything together, it really is a full model market timing machine, because when you know time is coming into play where you're supposed to be looking for a reversal, and if sentiment is not hitting extremes, most likely it's not going to turn on that time period. But when you have sentiment and time, now you look at the technical part of it, and if you have bearish divergences that are in line, now you can do Elliott Wave. And that's what I do. I do it on a short-term basis, and I really don't even show it when I do my reports, because everybody wants to know just what should I be doing. Should I be buying or selling? They don't really care about the what wave we're in. You guys are subscribing to our service because you want to know, should I be looking to buy, should I be looking to sell, should I move to cash? And that's pretty much how this works. And we've gone a little bit deeper into things where I've been just sending out buy and sell triggers, and you guys do the stuff on your own. I just let you know what I'm doing, and it's really been working out. And I want to show you a couple things before I go into our regular analysis now. And these are in the reports that I showed you with the May 22nd, and what this was showing was that it was looking for a low in early May, followed by strength into May 25th, or even into June 5th. So if we take a look at what sentiment was doing there, this is going into the 25th, and then from here it went a little bit further, but you can see people were getting very, very bullish on this market, and from there, that's when the market rolled over. And if we then take a look at the next one. We have this is on our June 21st. He was looking for a low to come in between June 26th and June 27th. So you knew heading into these dates, if you're short, you want to be either moving to cash, closing your short positions, or perhaps looking long. And that's really the way this works. It doesn't mean like on the 25th we made a minor top, but we went down and then went back up again. And then after we got into the 5th, June 5th, this is where your warning flags have to come up. And what I do personally is I move to cash, and then from there wait for a short signal to trigger me on the long side. So if we come here, this is the 26th. Notice how everybody got bearish on the markets. That's when it turned. And if I'm going to show you a chart right now, this is what I'm talking about with the as far as the warning signs. So this is June 5th. So the market continued up, but if you notice, we didn't have any sell signal. And a sell signal is when we make this top and we make this low, the market has to come down and take this out. That would be your short trigger. We went up, came down. So once we came down here, this would be your short trigger. Never took it out, went up, came down, and went up again. This is your short trigger. So getting short at 27.78, and now remember, we knew when the low was coming. It was coming between the June 26th and June 27th. So we made, this is where I covered my short positions. We went up, and this was a false move right here. I did take a long position because it looked like it was breaking out, but we came back down again, and when we came back up again, this was the next long trigger. So it was down at 27.12. So once we got up here, I removed this position because this had a little bit of stress in it. It came back down, and I just held on to the 27.12 with my stop down here. So I had very limited risk on this move. I was 15 points on the S&P, and from there, now I just manage this long trade as we go into the next turn date. And that's where I'm saying, if you don't know when to expect the top, you're going to see everybody starting to get bullish up here, and personally I think we could head higher on it. But people are going to get bullish at the exact wrong time, and that's what I'm talking about. Being able to use your, you know, the three things that make up our predictive analytic model: time, sentiment, and technicals. So if we take a look at the S&P, we already know when the time period is. I'm not telling you that. I can't tell you that because we have, you know, we're a business to make money. That's unfortunate. I give you these free reports to kind of give you some clues on what's going on. But the paying members, the biggest difference, they know these dates. I can't give them to you. Otherwise, we'd have everyone just come to a free member and we'd be out of business. So we know when to expect a top. The last 2 days, we've had very, very strong days. Sentiment is going to come in at a high level, so it doesn't mean that it has to top right there. And if we look at a technical point of it here, we don't have any bearish divergences. So as we head into the next turn date, what I'm going to do is I'm going to start scaling out of my long positions. I took some on Friday because this was my target one when we were all the way down here, that we're going to come up to the 27.65. So I took some more off, and I'm holding a very small position. And when we come up and get into the 27.75, which is the next target, I'll probably move to cash. And honestly, I would not be surprised to see the S&P trading up at the 27.92, or possibly even all the way up to this up to the 28.13, because that is the I'm sorry, this is not even the where I'm looking here. 28.13. Here we go. This is the here it is. Sorry about that. This is a gap that's open. Would not surprise me. But the thing is so some people may be asking, why not hold it all the way up there? Because when we start running into the time period to expect a top, it makes it risky. And remember that, you know, this slide, it doesn't mean that, you know, it has to turn right there. You're just in risk. And what I like to do is simply move to cash. And what I was telling members today, I may run with just stops. So if we take out these highs here, I may just put my stop at 27.55 and see where it goes, and then just keep moving it up. But my point is, if we get up here, it's right now when we get into that turn time that we're expecting the top, it doesn't make the long side safe anymore. It doesn't mean we can't go higher, but what you do is you don't make a trade. Whenever, if you get stopped out or it hits target and you just move to cash, you just let things play out, because the higher it presses and nobody thinks it's going to go down, guess what happens to sentiment? You start getting these extreme bullish sentiment readings. Then you're going to have time and you're going to have sentiment, and then you just wait for a technical reason to get short, and that would be a lower low, and again you put your stop at the high, and that's the way this works with it. And it's been like I said, one of the best trading years that I've had in many years, because they're following these turn dates exactly. When sentiment gets into extreme, the only thing I do as a technical aspect of it is just wait for a buy sell signal or where the targets are going to be. So everything is working out. Again, if they had higher tomorrow at the open, I'd look for the 27.75. What would make sense also is a little bit of a pullback down to the I would say somewhere in the range of the 27.50 area. And the reason why is we don't have any bearish divergences. So if we get a little bit of a pullback, then what happens is our technicals are going to start bending down here, and then we make another higher high, and from there we get the bearish divergences, and then that is going to put our the three methods of our predictive analytic model into play. You'll have time, sentiment, and price. But again, don't try to guess when the time is. Just because I'm talking about where to look for a top, you can't. I've gotten too many nasty emails saying that I was expecting this when they didn't know what I was expecting, because we had a specific time period that we were looking. So I'm not trying to mislead you on this stuff. I'm trying to show you where things are, what we look at, and we know when the top is supposed to be coming. Then we just wait for a technical sell signal and we go short, and we're going to do this month in and month out, and it's really going to be I don't see that this year changing at all. We're going to have market volatility throughout the year. So again, the first resistance 27.75. The next one is going to be 27.83 and then 27.91. I would not be surprised at all to see a move come up to the 28.13 as well, and that will also set up some bearish divergences on the daily chart. So with that, enjoy the rest of your weekend, and I will talk to you at the next free video. Take care now.